I'm Erik Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Glenn August, one of the pioneering investors in credit markets. Glenn's firm, Oak Hill, stepped up early with rescue financing for companies crushed by the Covid-19 pandemic. Now, months later, he still sees opportunities to make double-digit returns.
COVID didn't go away, and COVID is not yet gone, even if there's progress on the vaccine. When you shock a system, when you shut down businesses for months, or travel-related sectors where travel might be down 50 to 80%, those businesses, the marginal customer adds so much incremental profitability that the damage is deeper, the need for liquidity is greater.
To Glenn, investing isn't about making binary choices. Everything is relative, and Oak Hill is picking its spots. Keeping the Equinox gym chain out of bankruptcy, steering clear of energy, expanding into real estate credit, going all in on SPACs. Here's my conversation with Glenn August. Glenn, credit markets were supposed to be the killing fields of the pandemic. What happened?
Well, you had a handful of things happen, Erik. You had the Fed being incredibly accommodating, both in lowering rates and making large-scale asset purchases. You had the Congress and the President enacting major stimulus, which clearly took some edge off of the extraordinary nature of the pandemic. And then, that's not to say there hasn't been incredible loss across our country and across the world of lives lost from this pandemic. Small businesses that have been perhaps forever challenged to exist. But as a big picture matter, we all know we bottomed on March 23rd, and by middle of April, certainly by the end of June, the bulk of the damage had been recovered. And really what that led to over the last few months in the credit markets, where there still, by the way, has been opportunity, and I think will be opportunity, the credit markets bounced back dramatically, except for the COVID-related sectors, and as well as sectors that were under immense pressure prior to COVID, like energy and retail. So I think that the markets responded much like the equity markets did. We all know what happened to the equity markets. And the Fed clearly provided a backstop for all markets to basically rally.
So let's talk about where things are right now. Rates are at zero. Spreads are tight. The new issue market is humming. There's not a lot of distress, almost no forced sellers. Plus, the election uncertainty has been lifted and there's progress on a vaccine. How is anybody in your business supposed to make money under those conditions?
So there is a spectrum of value opportunities. And credit is an asset class like equities, like real estate, like venture, like growth, that all have a range of value offered to investors at certain points in time. So there's no doubt, certainly with the benefit of hindsight, and you and I spoke back a few months ago in the midst of it, we talked at that point about the extraordinary value that was present in the market, and our firm taking very substantial action to seize on that opportunity.
Right, but then poof, it was gone.
Well, it's not poof, because COVID didn't go away. And COVID is not yet gone, even if there's progress on the vaccine. When you shock a system, when you shut down businesses for months, or travel-related sectors where travel might be down 50 to 80%, those businesses, the marginal customer adds so much incremental profitability that the damage is deeper, the need for liquidity is greater. And while I will certainly tell you that in most sectors there's been a major recovery, that there's still value in segments of the market, I'll also say that even when we get through COVID, which I believe we will, and certainly hope and pray that we do, credit as an asset class, below investment grade credit, has a place in people's investment portfolios. There are segments in the below investment grade credit market, like leverage loans and high yield, where I do believe you can generate 4, 5, 6, 7%. I do believe there are segments in the private credit market, both in terms of liquidity financing and in terms of financing and new deals where you can make 8, 9, 10, 11, 12. I do believe that you can play for shorter term in COVID sectors, notwithstanding the fact that you don't want to go there, but shorter term liquidity provision where you can make 10, 11, 12, 13, 14, 15. And I believe that when you take leadership roles in distressed and you convert debt to equity, you've now become given yourself a chance to make 15+% returns. And so, again, from my perspective, and we spend an enormous amount of time with some of the largest investors in the world, asset allocation is incredibly important. And while yes, the more demand you have for an asset class, the lower the returns are going to come. Don't forget, there's been an explosion in the private equity market because people are seeking to make double-digit returns to throw into that mix of assets. And so the market is growing at the same time the demand is increasing. It's a bit circular, but I think there's still opportunity.
So some of the numbers that you just cited aren't all that different from where we were pre-pandemic. Presumably there has to be some kind of impact that all of the Fed stimulus and all of the fiscal stimulus has had on the kinds of returns that somebody in your position can generate. Quantify that impact.
Sure.
Is it like 2 percentage points? Is it 5 percentage points?
So it's a great question, but I would answer it first by stating what should be obvious to all investors. The equity markets today, notwithstanding COVID, notwithstanding the pandemic, notwithstanding the election uncertainty, notwithstanding issues that might be bubbling in China and U.S. relations, we'll see where that goes, notwithstanding a whole host of issues, are trading at all-time highs. So all investors have to benchmark and build that asset allocation based on what are the available opportunities. You can sit home all day and make zero. That's not a viable option for most institutional or individual investors. And so the question is, where is the best risk-adjusted return?
Okay, these are good points. But you've also heard the other argument, which is the reason all of those things are trading at all-time highs is because the Fed cut rates to zero and the present value of all future cash flows had to be discounted. We're using a different number, and so we've pulled forward future returns, which then throws into question this idea that you can get 15% in a distressed portfolio, or you can get high single digits, in a leveraged credit portfolio.
So there's no doubt that where the Fed is today, where interest rates are today, should lower expected returns. Okay, and if you ask me my view on private equity, I don't think it is easy to achieve 20+% returns. And I don't sit here today saying it's easy to achieve 10 to 15% returns. But I believe, as I've believed for a very long time, if you invest in good businesses with good management teams, with good competitive positioning, when you invest in the debt level of a capital structure at 50% loan to value, even if the value piece, the LTV, the V comes down by 25%, you're still at 2/3 loan to value and you're money good. I like to tell the story.
So different if you're a creditor than if you're an equity investor.
It's very different if you're a creditor, which is why, again, I happen to believe that relative value credit continues to be interesting, not just on an absolute, but on a relative value basis. But I like to tell the story of our experience in 2008 to 2010. Because I tell the story and I say, if you looked at our portfolio on July 1st of 2008, and you went away to a remote location somewhere in the world where no phones, no email, no faxes, look at me dating myself, no means of communication. And you went away for 2.5 years. So you left on July 1st of 2008 and you came home on December 31, 2010. And I showed you the portfolio before and I showed you the portfolio afterwards. You would have said, oh, I guess it was a quiet 2.5 years. We were up on some of our portfolios, our average portfolio, 35% over 2.5 years. Forget the global financial crisis. And we have seen this time, and it's been pretty extraordinary from my perspective, I make no mistakes, the speed of the recovery, the willingness of people to discount the end of COVID, the willingness for people to assume that the Fed will keep rates low for a very long time, the comfort that this is a good will give us the opportunity to grow the economy again has given people across all markets a level of confidence. And again, maybe that confidence might be too exuberant in terms of the level of comfort. But again, I believe it's not about, certainly our investors care day to day, week to week, month to month, year to year. But if you look across a period of time and you have the ability to select good companies, good layers in the capital structure, good securities that can offer good risk-adjusted returns, I think it makes sense.
Does a Biden presidency change the outlook?
So I've been talking to investors about what a Biden presidency means, and clearly, while there's uncertainty today, we've only answered one question today, and that is the Biden presidency. We've not answered the Senate. There's obviously 2 runoffs in Georgia. If the Republicans win one of those, then they have control of the Senate. It would appear likely, but it'll be one of the most expensive races of all time because it's all on the line. I believe that a Republican Senate and a Biden presidency supported by a Fed that continues to be accommodating, I believe that is a Goldilocks scenario for the markets. Because I believe, and I confess I'm much more of a centrist, respect people on both sides, but I believe that moving too far to the progressive agenda with materially higher tax rates, Green New Deal, et cetera, would give the market some meaningful pause. I believe if we went the other way, there might have been some risk as well. And so I think this scenario is generally speaking, and the markets have spoken thus far, is a very constructive backdrop for investing. But I want to make one last point, and that is, like anything else, like any moment in investing, there are winners and there are losers. There are sectors under immense secular pressure. There are sectors that are big beneficiaries in a post-COVID world. And so for people like myself, the ability to choose where to invest, both in terms of industries, companies, geographies, where in a capital structure to invest. I often tell the story that I don't make the market set of opportunities. I liken it to a buffet. When we all go to a buffet, some days the meat looks good, some days the fish looks good, some days the vegetables look good, some days the fruit looks good. They don't always look good.
Somewhere along the way, over the past 9 or 10 months, investors had to decide, do I or do I not buy anything that has COVID exposure? And many didn't, of course. You did.
Yep.
How did you get comfortable with the risk?
So, there's no magical answer. I had a lot of confidence in the scientific community that, just like we have done before, we've attacked disease. I believe the effort that was made across hundreds of companies to find a vaccine, to develop better therapeutics. I happen to sit on the Mount Sinai Hospital board. I had a window into what was going on there. The treatment of COVID became so much better from what we saw in the early days. So I believe that it was not a matter of if, it was a matter of when. And so that perspective gave us enormous opportunity to seize on the moment. Carnival Cruise went from $50 billion of value to $15 billion enterprise value. They needed cash. You shut down the system, there's no cruises. We bought a piece of paper in Carnival Cruise. We made an investment in Carnival in an 11.5% secured bond, secured by all of their cruise ships, at the $7 billion valuation for a company that was worth $50 billion. That piece of paper today is trading at 113.
Yes,
and
but
so,
you had to have the confidence that people would cruise again, because if they didn't,
if
the cruise ships wouldn't be worth $7 billion of scrap metal.
If we ended up staying in our houses forever, then I can assure you we would have lost money. okay? And if the world literally shut down forever, but I wasn't willing to make that bet. And I did have belief that at a minimum, that the combination of, forget about a vaccine, but the combination of therapeutics and government action would ultimately lead to this passing over time.
Today, you're a lender to Equinox, the gym operator.
Yep.
Do you believe people will give up their Pelotons and go back to the gym?
So, well, I think that the answer is yes. Not all of them, but not all of them have to give it up. Peloton has been an extraordinary success story. Although I will tell you that as positive news comes out on vaccines and other therapeutics, Peloton stock is down materially. I believe that fitness, gyms, health clubs are a place that is not just about working out, that there's a communal aspect to it. I believe Equinox is a really good company and well managed. I believe in the sponsorship. Prior to COVID, the company did some private financing that valued the company in excess of $5 billion. The debt that we bought was at the $1.3 billion level. Again, when I talk to you about any name, any company, it's not as a cheap, what happens if X, Y, Z happens? It's, do you believe in the business over the long term? Can you invest in the management? Do you believe in the management team, the competitive positioning, the opportunity for growth? And then, do you buy into a capital structure at a portion in that capital structure where you think the odds are in your favor to generate good risk-adjusted returns?
I get it. What happens to Equinox now? Moody's, for what it's worth, says there's a high level probability of default. Okay. Everyone is lawyering up. Can it avoid bankruptcy?
Equinox has issues and challenges. Companies that have been dramatically affected by COVID, as obviously a health club chain would be affected, have liquidity issues. They have debt that is coming due in February unless they can extend it or repay some of it. I believe long-term in Equinox, and I believe that the company and the investors will figure out a solution that avoids bankruptcy. By the way, to be clear, I may be wrong. I have been wrong many times, but I believe that where we are in that capital structure, even if, by the way, one of the things that we do in our analysis is we ask ourselves the question, if a company were to go into bankruptcy, would we still have the recovery that we like and are hoping for? And the answer is, not only is it a yes, but sometimes the recovery can be greater. Sometimes in much, I mean, you know, we've been a distressed investor for 30 years. In many of our investments, we've converted debt to equity and ultimately over the medium or longer term, generated substantially in excess of par. Substantially in excess of par. And so again, you can't look at any single investment in a vacuum and say, oh my God, what happens if there's bankruptcy? You have to ask yourself the question, what are the different scenarios? And if there is a bankruptcy or restructuring in any company, leave Equinox aside, the question is what happens, how are you protected, what can you do to affect the outcome?
So that raises a question for me. How much exposure do you have to Equinox now? And would you consider supplying the company with additional capital, particularly if it were to give you some kind of an edge in a distress for control situation?
I'm not going to comment on our current position size, but what I will say to you is that Equinox and companies like Equinox are the kinds of companies that we would support if what is the possible, what is attractive from a new investment in providing liquidity, providing certain terms. There are certainly terms on which I would provide additional capital to Equinox.
What do you look at and say NFW?
So I think that there are certainly segments of the market where the risk of secular change are just too great, or the reliance on commodity pricing is too great. So for example, there are certainly companies in the energy space, which they make up 30% plus minus of the entire distressed market, that have been, in some cases, permanently damaged or at a minimum had significant damage to their balance sheet, to their business. At $40 oil is different than $55 oil and different than $75 oil. And so companies that are on that bubble that are so sensitive doesn't make sense. That's one. Second thing I'd say, so we don't like making commodity bets because we clearly don't control the commodity. I can't sit here. I may tell you that I believed, even in the darkest moments of the COVID crisis, that it was a matter of when, not if. Mm-hmm. I can't tell you if oil is going to be $60 in a year from now or $40. Okay. The second thing, but I will say again, even in energy, there are segments in the market that actually can be interesting. And so you want more offshore exposure than onshore exposure. You want more senior investments with less debt than junior and more debt. So that's how I think about it.
Glenn, hundreds of billions of dollars have been raised since the start of the pandemic to pounce on distressed credit. And by and large, much of the distress that was foreseen at the time hasn't unfolded. Will that distress ever materialize?
So the answer is we don't know. I don't know. If you look at signposts, if you look at what the equity market is telling you today, if you look at what the Fed is telling you today, if you look at what you think might happen in a Biden administration, then the answer is it is less likely than more likely to be a wholesale distressed opportunity. I think perhaps the greatest distressed opportunity over the next 2-3 years is going to be in the real estate markets, because a handful of reasons. Number one, a lot of the holders of real estates were highly, highly levered. Number two, you've had massive secular change here, or acceleration of change with regard to what happens post-COVID with work from home, and is there less demand for office space? What happens on business travel? How does that affect the hotel sector? There's a lot of excess inventory in New York City here of condos that got built assuming a $2,500 a square foot sale price, where I think most people would feel lucky if they got $1,500 to $2,000 a square foot, which is crazy numbers. We'll keep that aside. So I believe, and we recently made a very significant hire. We brought on Matt Borstein to help build out a real estate business for us. And I think that is not just a 3-month opportunity. I think the provision of real estate finance, both from a dislocation standpoint, liquidity standpoint, and new transaction standpoint, is going to give us some great opportunity.
As you know well, distressed credit was never a particularly friendly place. But lately, the hostility has reached a new level. You're nodding. Perhaps you agree. I want to know, Glenn, what do you make of these priming or up-tiering deals?
Sure.
There's various terminology in which some creditors are conspiring with borrowers to disenfranchise other creditors.
So I'm not going to use those words. What I will say is there's an ecosystem that a challenged or distressed company lives in. And in that ecosystem, there is typically bank debt holders, there are bond holders, there may be private equity or public equity, and each of those investors has a fiduciary duty to maximize the value of their investment. Okay? This is a great example of where scale really matters. The ability to help in a restructuring and write a $300, $400, $500 million check of new liquidity. The ability to convert debt to equity when some funds don't have the ability to do it. That does create opportunity, it does create potential for conflict. And so, by the way, it also is exacerbated by the fact that the documentation has given a lot of opportunity and flexibility. And so there are positives and negatives. If you can provide additional capital to prolong a company's life and let it continue to grow and give it the capital, society might say that's a positive. If in so doing, some investors who have no capital, don't have that opportunity, may say that's a negative. And so I don't sit here today with a moral judgment of what's right and what's not right. We all obviously have our fiduciary duties. We have worked over 30 plus years to build the scale business that we have, to use our knowledge, our relationships.
So it's not an ethical question. In other words, every party, be it equity or creditor, should do everything possible to maximize his or her returns.
There's always ethical questions in business, but I would say as a general matter, if you own debt in a company, I believe it's your job to figure out how do you maximize the value of that debt.
Is there a line you've drawn so far that you're not prepared to cross?
I can't think of that line today.
Tell me about the SPAC craze and where you see Oak Hill fitting in.
So it's a pretty extraordinary phenomenon, and it was obviously a market that a decade ago people wondered if it really was part of the institutional set of options to take a company public. There was a sense that the sponsor promoter might be getting too good a deal. Were they really adding value? Could you just take a company public? And I think in the last couple of years, that notion has changed, and I believe it's changed for the right reasons. I believe there have been SPAC teams, and like anything else, not all SPACs are the same. And I'll say with full disclosure, at Oak Hill, we are a strategic partner with Michael Klein at Churchill, and I believe that Michael has built a differentiated approach to doing SPACs. He's got a bench of 20 to 30 different CEOs, including Alan Mulally, Joe Ianniello, some of the largest names in the industry, Andrew Liveris, and the knowledge and the resources that he and we together can bring to help create value as part of an IPO process, and then more importantly beyond, I think is pretty significant. Now, do I think that the air will come out of the bubble, as it started to in some spots, where people just raise a SPAC because they like the sponsor economics and they don't really have any differentiated strategy? The answer is yes. Those will ultimately fade away, but there's a lot of great executives backed with good, smart, thoughtful partners, and I think SPACs are here to stay. And I think for our firm, for what it's worth, I think there's an incredible opportunity, because I believe not only can we work with Churchill and in some cases some others to provide capital as part of the go public transaction. As you know, Churchill did a transaction with Multiplan, $11 billion deal, the largest deal of its time. And as part of that transaction, we at Oak Hill helped structure a $1.3 billion convertible debt piece of paper. We had followed Multiplan for a decade through a series of different private equity owners. And we believe that the opportunity to get a debt downside protection with optionality on a convert to the extent things work out the way we hope they will, gives us the opportunity to make a 15+% return with downside protection. So I think that being thoughtful about capital structures and SPACs is going to be very, very interesting. But long story short, I believe that SPACs can be an important part of the go public process. Some companies can tap the IPO market anytime, but then if their stock goes up 30, 40, 50%, was that better than doing a SPAC deal where there was less giveaway to the investor? So I like SPACs. You got to be differentiated. I also think there's co-investment opportunity for people like ourselves.
What does expanding into real estate credit say about your ambitions for the firm?
We won't do things unless we think we can do them well. I happen to believe that real estate credit is a very logical adjacency. We've invested billions of dollars over the last couple of decades in stressed and distressed real estate, and understanding capital structure, sponsors, and so on. And so that's how I process it.
How do you balance the need to maintain your culture and to invest well with the reality that scale matters? You've got $45 billion and climbing. There are others who have $250 billion. Right. That 5X factor is meaningful.
Well, you know, it's funny.
Or maybe not, you tell me.
What I would say is, A, there's not a race here. There's never been a race to grow. The most important thing for us is to have sufficient scale to be relevant to the people that we're investing in and to the people who give us money. And I would put forward at $45 billion today We have that scale. And we have that relevance. And one of the things I've said for a really long time and still believe at the core, that it's not, we want to be large enough to have scale and relevance, but small enough to be nimble. And I will tell you, I still feel that today at our size. I can't tell you, hopefully I will never feel otherwise, and I don't think it's just rationalizing. But I look at where I gave you the private credit example, just for a moment. If you want to write a $500 million check to be supportive of a private equity deal, and you say to yourself, I don't want any position being more than 5%, you need a $10 billion denominator. If you say it shouldn't be more than 2.5%, you need a $20 billion denominator. What I really like about where we are today is we have the scale to write that $500 million check. And in a funny way, there's less competition because there's fewer people that can write that and provide that kind of, not just capital, relationship, structure, flexibility, solution, et cetera.
Glenn, I know a few investors of more recent vintage than you who look at Oak Hill and say to themselves, that's a firm built for the old world. We're in a new world. I want you to be Dirty Harry for just a moment. What would you say to those punks?
What people really want, people who've been doing this business for 10, 20, 30 years, they want someone that they trust. And that trust is either from the companies that you're investing in or the people that are giving you money. And I have this phrase, like, trust, and respect. And I believe that's the essence of what partners want. They want to like you, but they got to also trust you that you're never going to harm them, and they got to respect you and think you're really good. If it's just one of the three, it doesn't work. If it's just two of the three, it doesn't work well. And our goal as a firm, my goal as the head of our firm, is to make sure that people that we deal with, whether it's companies or investors, like, trust, and respect us. And that's the way we look at it. So
We'll leave it right there.
thank you.
Thank you.